If you've got a 401k, you own the S&P, the Nasdaq, or you've got straight-up Nvidia stock, because AI only goes up, then what I'm about to walk you through could be the difference between cruising into retirement or getting blindsided by a shift most investors are massively underestimating right now. Because Nvidia hasn't just launched another chip, they just wrote a $2 billion check to buy a chunk of Synopsys, the quiet, ultra-profitable software company behind a huge percentage of the world's chip designs. And they tied it to a multi-year AI and digital twin partnership that changes who controls the picks and shovels of the entire semiconductor and engineering ecosystem. And the wild part? Most retail investors don't even know what Synopsys does, let alone why Nvidia just paid around $414.79 per share for roughly 2.6% of the company, in one shot, in cash. If your money is in the S&P 500, the Nasdaq 100, or any big growth ETF, you are already exposed to this story whether you like it or not. My promise to you is that by the end of this video, you'll know exactly what this Nvidia Synopsys deal really is, how it could reshape the AI and chip design landscape over the next few years, and the way I'd be thinking about Nvidia, Synopsys, and even your index funds before Wall Street fully prices this in. This is not a doom and gloom, Nvidia is finished video. Nvidia is still a beast, but it is a realism video about margins, power, and where the profit pool might quietly shift next. Welcome back to Econ Rewind. Around here, we break down big economic and market moves in plain English so you can actually use them in your portfolio. I'm a former equity analyst turned full-time investor and educator, and I spent years on the street modeling exactly these kinds of companies: semis, EDA, infrastructure, for clients managing billions. Now I use that background to help you understand what's really going on behind the headlines. When a deal like Nvidia taking a $2 billion stake in Synopsys hits, this isn't just one more AI headline. It's a structural move. So let's start with what actually just happened. Nvidia did not buy Synopsys outright. This is not a full acquisition. What they did was announce an expanded strategic partnership with Synopsys, tied to AI, digital twins, and engineering workflows. And, as part of that deal, Nvidia invested roughly $2 billion in Synopsys common stock at $414.79 per share, giving them about 2.6% ownership. On top of the equity piece, the commercial side is big. More than a dozen Synopsys applications are going to be accelerated using Nvidia GPUs and CUDA-X libraries, and the companies are leaning into using Nvidia Omniverse to build digital twins for chips, systems, and even entire factories. The pitch is that engineers can design, simulate, and optimize faster and cheaper by running Synopsys plus Ansys tools on Nvidia infrastructure, wrapped in AI. The market's first reaction was telling. Synopsys popped, mid-single digits to near double digits on the news, depending on when you look at the tape, while Nvidia dipped a bit, about 1 to 2%, in a softer tape. Classic reaction. The smaller partner gets the pop, the giant buyer gets a, another big check. Let's think about that. One important nuance. This deal is non-exclusive. Synopsys still works with other chip players. Nvidia still works with Synopsys' rivals like Cadence. Nvidia hasn't locked up Synopsys as a private toy. What they've done is tilt the playing field in their favor and bolt their engine under a platform that already sits in the middle of chip design. Now, if you're a normal investor, you might be thinking, okay, AI software, EDA, digital twins, that sounds fancy, but why should I care if I'm just in the S&P? Because Nvidia and Synopsys are exactly the kind of names that quietly drive a disproportionate share of your long-term returns. Nvidia, you already know, king of AI GPUs, monster data center revenue, the stock that has hauled the indexes up by their collar. Synopsys is more behind the scenes. They don't manufacture chips. They sell the software tools and IP that everyone else uses to design those chips. This whole category is called electronic design automation, or EDA. Think of it like this. Nvidia sells the shovels for the AI gold rush. Synopsys sells the maps, CAD tools, and blueprints that tell everyone where to dig and how to shape the shovel in the first place. And that's before we even talk about Ansys. In 2025, Synopsys completed its $35 billion acquisition of Ansys, which is a monster in physical and multiphysics simulation. Thermal, structural, fluids, electromagnetics, all of it. That means Synopsys now sits at the intersection of chip design, system-level simulation, and now, through Nvidia, GPU-accelerated AI and digital twins. So when Nvidia slides $2 billion across the table and wraps it in a multi-year AI and Omniverse partnership, what they're really doing is bolting a gigantic Nvidia GPU engine under the hood of the global design stack. From the level of electrons and transistors all the way up to cars, planes, data centers, and factories. If that works, an enormous amount of future engineering and simulation work could gravitate toward a stack that looks like Synopsys plus Ansys software running on Nvidia GPUs, orchestrated with Nvidia's CUDA and Omniverse as the backbone. If you own the indices, big growth funds, or AI-themed ETFs, this isn't trivia. This is the plumbing that determines where the margins live for the next decade. Let's zoom in on Nvidia's side of the board for a minute. Nvidia is already the de facto standard for AI compute, but they are very aware of two big risks. Number one, commoditization risk on hardware. Over time, as competitors catch up and custom chips from cloud giants ramp, it gets harder to justify extreme margins purely on speed. Number two, they need to stay deeply embedded in real workflows. Not just AI researchers and data science teams, but chip designers, mechanical engineers, automotive, aerospace, industrial companies, the people who actually build physical things. Partnering with Synopsys hits both. Synopsys is one of the main gateways into the physical world of chips and systems. Chip designers live inside Synopsys tools all day. Now, with Ansys in the fold, system and multiphysics engineers are in that universe too. If Nvidia becomes the default compute platform inside those tools, they become the default for the entire design process. So instead of just saying, hey, we have the fastest GPU, Nvidia is effectively saying, if you want your EDA flow, your system simulation, your digital twin, your AI-assisted design agents to run at full speed, you really want to do that on Nvidia. That's a much deeper lock-in than just hardware specs. That's workflow lock-in. The other key shift is that Nvidia isn't content being just a chip vendor. Listen to the language they use. Agentic AI for engineering, AI physics simulation, Omniverse-based digital twins of products and factories. That's Nvidia saying, we want to be the operating system for industrial R&D. And they're putting their money where their mouth is. This Synopsys stake is part of a pattern. In 2025, Nvidia has poured tens of billions into the AI ecosystem. Stakes in AI companies, a multi-billion-dollar deal with Intel, a huge circular structure with OpenAI where Nvidia invests. OpenAI builds data centers, and those are stuffed full of Nvidia hardware. The Synopsys check slots neatly into that strategy of owning critical nodes in the stack. Now, let's flip it. What's in it for Synopsys? Synopsys is already a juggernaut in EDA. High margins, sticky customers, massive market share. With Ansys, they're trying to extend that dominance into broader engineering and simulation. But with that come challenges: exploding design complexity, rising compute costs, and the need to keep innovating when your customers are some of the most demanding companies in the world. Plugging into Nvidia gives them a few very concrete advantages. First, they get to supercharge their tools with GPU acceleration and AI. A lot of the heavy workloads in EDA and simulation are perfectly suited to GPUs. Circuit simulation, place and route, computational lithography, massive verification runs, full system-level analyses. Offloading those to Nvidia GPUs and layering in AI models can shrink runtimes, open up new optimization approaches, and make what-if exploration much cheaper. Second, they get a really strong marketing story. If you're Synopsys, you can walk into a customer meeting and say, "Look, we've integrated tightly with Nvidia's latest GPU and AI stack. If you adopt our joint flow, you can cut design cycles, get better PPA, power, performance, area, simulate more scenarios, and do it all faster." That plays extremely well in boardrooms where time to market is everything. Third, they got a very real financial and sentiment boost. The stock had wobbled earlier in the year around earnings and macro concerns. Getting a $2 billion endorsement from Nvidia and a multi-year partnership signal says to the market, this is not just another software vendor. This is core AI infrastructure. That's exactly why you saw that pop on the announcement. There is a subtle risk for Synopsys, and it's worth saying out loud. Even if the partnership is technically non-exclusive, the moment Nvidia owns a chunk of your stock and puts your logo on their AI slides, other customers notice. Competitors like Cadence can lean into the "we're neutral" angle. Rival chipmakers might be a little more cautious about over-relying on tooling that's heavily branded with the leading GPU supplier. Synopsys has to milk the upside without looking like Nvidia's captive. Let me step back and give you the bullish version of this story, then we'll talk about the risks. In the optimistic case, this deal is the front end of a huge, long-term integration of Synopsys EDA for chip design, Ansys for system-level multi-physics simulation, Nvidia for compute, AI, and 3D/digital twin visualization. Imagine you're an automaker. You design your chips in Synopsys. You simulate the electronics, thermal, structural, and fluid dynamics in Ansys. You connect that to a full digital twin of the car and the factory in Nvidia Omniverse, all running on Nvidia GPUs. You can iterate designs, test edge cases, optimize for cost and performance, and you do it with AI agents helping your engineers explore solutions. If that becomes the default way serious companies design products, Nvidia cements itself as the physics and AI engine of industry, and Synopsys becomes the cockpit where the engineers live. In that world, both companies can justify premium valuations for a very long time, because they're not just cyclical chip names. They're the backbone of the AI-driven industrial stack. Now, the less fun part. What could go wrong? The first concern is this whole ecosystem starts to look circular. Nvidia invests billions into partners. Those partners, directly or indirectly, buy Nvidia hardware and services. Revenue goes up, but some of that demand has been effectively pre-funded by Nvidia itself. That doesn't make it fake. The chips are real, the workloads are real. But it does mean you have to ask how much of the growth is organic versus engineered. The second concern is regulatory and political. Nvidia already dominates AI GPUs. Now, layer on stakes in chip companies, tool vendors, and huge commitments to firms like OpenAI. At some point, regulators are going to look at vertical integration in AI infrastructure, from chips to models to data centers to tools. Even if nothing gets broken up, investigations and uncertainty can weigh on investor sentiment and multiples. The third concern is competitive response. AMD is not dead. Intel, for all its struggles, now has Nvidia money and government interest as it tries to reassert itself. The major cloud providers, Google, Amazon, Microsoft, are continuing to push their own custom silicon precisely because they don't want to be hostage to Nvidia forever. This Synopsys deal makes Nvidia stronger, but it also makes the threat more obvious, which can accelerate those competitive efforts. And then there's the boring but deadly one, valuation. Nvidia and Synopsys are both priced for excellence. Markets have already priced in a lot of growth, a lot of dominance, a lot of execution. When that's the setup, you don't need a catastrophe for stocks to stumble. A slowdown in AI capex, some regulatory noise, a bit of disappointment in how fast these AI-accelerated tools ramp, any of that can compress multiples and give you a flat or choppy stock while earnings grow underneath. So when does this actually matter? Is this something for 2030, or does it hit you sooner? In the very short term, the impact is mostly about narrative and positioning. Synopsys gets an AI halo. Nvidia adds another "we're everywhere" bullet to its story, and institutions reposition a little. If you're in broad index funds, this barely registers as a blip on your monthly statement. Over the next 1 to 3 years, this is where the rubber meets the road. You'll start hearing about Nvidia accelerated features inside Synopsys and Ansys tools. You'll see case studies where customers brag about, "We cut our simulation time by X%," or "We were able to explore Y times more design options because of this combined stack." If those stories are compelling and repeatable, it reinforces the idea that this trio is the default for serious engineering. Beyond 3 years, you're in structural territory. If this works, Nvidia and Synopsys become deeply embedded in the design loops of entire industries. Chips, cars, planes, grids, data centers. If it doesn't, you'll see more mix-and-match approaches, open ecosystems, other accelerators, more neutral tool chains. Either way, this deal is going to have influenced billions in capex decisions and a lot of career risk among executives choosing which stack to back. Now, what do you actually do with this as an investor? If you're mostly in broad index funds, S&P 500, total market, big growth ETFs, the main thing is awareness, not panic. Know that a lot of your future returns are tied to a relatively small handful of AI infrastructure names. Nvidia is one of the biggest of those. Synopsys, post-Ansys and post-Nvidia stake, is climbing that importance ladder too. Make sure you're not accidentally doubling or tripling your exposure through side bets, thematic ETFs, and individual picks all pointing at the same cluster of names. If you own a ton of Nvidia directly, forget Synopsys for a second and ask the uncomfortable question. If Nvidia dropped 40% over the next 2 years, but remained a fundamentally strong company, would I be okay? If the answer is no, then your problem is position sizing, not news headlines. In that context, this Synopsys deal is one more long-term moat-building move. It's Nvidia trying to own not just the training of AI models, but the entire engineering design loop. It's also another big strategic check, another node in a web that regulators might eventually poke. It doesn't change the core thesis overnight, but it raises the stakes. If you're looking at Synopsys as a potential opportunity, recognize that the market has already repriced it as more than just EDA. You are no longer buying only a mature, high-quality design tool business. You're also paying for optionality on being the AI-accelerated engineering OS, with Nvidia at its side and Ansys integrated. That's powerful, but you want to be careful about chasing short-term excitement. Think in terms of valuation bands, scaling in over time, and watching very closely how quickly AI-accelerated features turn into real, paid product, not just demos. Underneath all of this is a bigger question. Who owns the design loop of the future? Not just the training of foundation models, not just the sale of chips, the full loop. How chips are conceived, how products are simulated, how factories are planned, how digital twins are built, updated, and used in real time. Nvidia is betting that by owning the compute, the AI stack, and now key entry points in the tooling world, it can be the default backbone of that loop. Synopsys is betting that by owning EDA, owning Ansys-level simulation, and being tightly wired into Nvidia's platform, it can be the cockpit where the world's engineers live. If they're right, both keep compounding for a long time. If they stumble, value leaks out to competitors, more open ecosystems, and other accelerators. Your job is not to predict every twist. Your job is to understand what game is being played, decide how much of your portfolio you're willing to tie to that game, and make sure you're not the last one to find out when the rules change. If you got value out of this, hit like, subscribe to Econ Rewind, and share it with a friend who owns Nvidia or just the market in their retirement account and has never even heard of Synopsys. They're in this story whether they know it or not.